Right now, as we watch the markets react in real time, Datavault AI Inc., trading under the ticker DVLT on the Nasdaq, is exchanging hands at approximately $1.89 per share, taking a massive hit of roughly 18% in intraday trading so far. This sharp downward volatility is catching aggressive traders off guard, especially after the stock had shown some resilience in pre-market hours, but the tape is now painting a very different picture. When you see a stock shed nearly a fifth of its value in a single morning, the immediate instinct for most retail investors using platforms like Robinhood or their Fidelity mobile app is to assume the company is collapsing or that a piece of catastrophic news has just hit the wires. The expectation here is standard for the microcap tech sector: a pump that has run its course, a dilution event that is crushing shareholders, or a business model that simply failed to materialize. You look at the chart, you see the red candles, and you think this is just another volatility trap that you should avoid at all costs. But the reality of what is happening with Datavault AI is far more complex and, frankly, much more interesting than a simple sell-off suggests. What we are seeing isn't just a panic dump. It is a chaotic repricing event following one of the most unusual capital restructuring deals we have seen in the small-cap space this year, involving Bitcoin, massive insider transactions, and a pivot that could fundamentally alter the company's valuation model. While the street sees a falling knife, those paying attention to the filings see a company that has just secured a massive runway through a $150 million transaction paid in cryptocurrency, effectively turning its balance sheet into a hybrid of tech IP and digital assets. This distinction between the scary price action and the structural capital infusion is where the real story lies. To understand why DVLT is trading with such violence today, we have to look beyond the immediate tick-by-tick data you might see on your Interactive Brokers trading platform and examine the structural shift the company just executed. The heavy selling pressure we are seeing right now, dragging the price down to that $1.89 level, is largely technical and related to the digestion of a massive equity financing deal with Scilex. When a company expands its authorized stock significantly, as Datavault just did, effectively clearing the path for hundreds of millions of new shares, the market naturally prices in dilution. It is the classic supply and demand mechanic. More shares available means each share is theoretically worth less until the capital raised with those shares generates a return. However, the mechanism of this deal is what stands out. Scilex didn't just hand over cash. They paid for a massive tranche of warrants using Bitcoin. This aligns Datavault AI not just with the data sector, but implicitly with the crypto markets, making its stock behave with a beta that is partially decoupled from traditional tech indices. So while you might be watching NVIDIA stock or Tesla stock for cues on market sentiment, Datavault is moving to a different drumbeat, one influenced by the liquidity of its major partners and the volatile nature of the assets sitting on its books. This drop to $1.89 isn't a sign of bankruptcy. It is the market attempting to find a floor price for a company that just radically diluted its share count in exchange for a war chest that it claims will drive revenue to $200 million by 2026. Let's pause on that revenue projection for a moment, because it is the linchpin of the bull case here. If you are using a tool like Schwab Intelligent Portfolios or browsing through investing sites looking for growth at a reasonable price, a microcap claiming it will jump from a few million in revenue to $200 million in 2 years usually triggers skepticism. And it should. But the specific nature of Datavault's business, monetizing data through AI and blockchain, is asset-light and high-margin. They aren't building factories. They are licensing intellectual property and creating digital twins of real-world assets. The recent sell-off we are tracking today ignores the fact that the company has started closing multi-million-dollar deals, including a significant agreement with Triton Geothermal and a partnership with the World Boxing Council. These aren't just press release fluffs. They are revenue-generating contracts that are supposedly starting to hit the books. The disconnect we are seeing today is between the backward-looking financials, which show a company burning cash and operating at a loss, and the forward-looking guidance that suggests an explosion in top-line growth. The market, in its current risk-averse state, is punishing the current dilution rather than pricing in the future growth. This creates a tension that is palpable. Traders are dumping shares to escape the dilution, while value-focused speculators might be looking at this $89 level as an entry point into a company that potentially holds a massive patent portfolio and significant liquid assets in cryptocurrency. Speaking of holding shares, I want to hear from you right now. Comment below with your average entry price if you are currently holding DVLT. Or if you are watching from the sidelines, tell me what price level you are waiting for before you start a position. It is always fascinating to see where the psychological support levels are for the retail crowd versus where the institutional algorithms are stepping in. Now let's peel back the layers on the business itself, because it is easy to get lost in the noise of the stock price and forget what the company actually does. Datavault AI operates in the intersection of three massive trends: artificial intelligence, blockchain-based data management, and the tokenization of real-world assets. In simple terms, they help companies and organizations take their massive pools of data, organize them using AI, and then monetize them by turning them into tradable, trackable digital assets. Think about a company like Apple stock, which has an infinite amount of user data. Datavault's technology is designed for enterprises that have that kind of data utility but no way to safely sell or leverage it. Their platform allows for the valuation and exchange of this data without compromising security. This is why the Scilex deal is so critical. It validates the technology with a major healthcare player. Healthcare data is incredibly valuable, but notoriously difficult to transact with due to privacy laws. If Datavault can successfully facilitate the monetization of medical data for Scilex, it proves their model works in the most regulated environment possible. This would ostensibly open the door for contracts in finance, logistics, and government sectors. When you consider the sheer volume of data being generated today, the total addressable market for this kind of service is astronomical. The question isn't whether the demand exists, it is whether Datavault can capture it before they run out of cash or dilute their shareholders into oblivion. This brings us back to the risks, which are substantial and must be discussed with the same seriousness as the potential rewards. The recent filing activity shows massive insider movement. We saw Scilex selling a portion of their holdings shortly after acquiring them, which can be interpreted in two ways. Bears will say it's a sign that the smart capital is cashing out immediately, treating Datavault as a liquidity event rather than a long-term hold. Bulls might argue it's simply portfolio rebalancing or generating liquidity for other operations. Regardless of the intent, insider selling creates headwinds. It puts a constant supply of shares onto the open market, capping rallies and exacerbating sell-offs like the one we are seeing today. If you are managing your own funds via a Fidelity brokerage account or using SoFi Invest to pick individual stocks, you have to be comfortable with the fact that you are swimming in the same pool as whales who can dump millions of shares on a whim. This is not like buying an ETF where the risk is spread out. This is single stock risk at its most extreme. The volatility in DVLT is compounded by its relatively low float compared to the total authorized shares. As those warrants get exercised and converted, the float will swell, potentially keeping the price suppressed for months unless the buying volume increases exponentially. The trading volume today is already elevated, which suggests that a churn is happening. Shares are moving from weak hands to potentially stronger ones, or are simply circulating among day traders looking to scalp the volatility. For those who utilize interactive brokers trading platforms, you might notice the spread is widening, indicating lower liquidity at specific price points, which can lead to slippage if you are trying to enter or exit large positions. This is a characteristic trait of stocks undergoing a repricing event. The market is trying to figure out if Datavault is a $500 million company or a $50 million company. The wide range of analyst price targets, some pointing as high as $3 or more, suggests that if the company hits its targets, the stock is currently undervalued by a significant margin. But "if" is the most dangerous word in investing. The $200 million revenue target for 2026 requires flawless execution. They need to close dozens of deals similar to the Triton and Scilex ones. They need to integrate their technology smoothly. And most importantly, they need to avoid further toxic financing that destroys shareholder value. We also need to consider the macroeconomic backdrop. We are in an environment where capital costs are high and investors are gravitating towards profitable, established companies. Speculative tech stocks, especially those that are pre-profit, face a higher hurdle rate. However, the crypto aspect of Datavault's